Well, good afternoon, everybody. I want to just get right into how we leverage the FANG stocks with weekly options. One of the things I think you got a lot of great speakers today to kind of soak in a lot of good market education. But I've been trading since 1990. Started BigTrends.com back in '99. One of the things I've learned is you've got to keep it simple. When you're in the heat of battle, you've got to really get focused on kind of one critical thing that you can do, and you know that okay, if that's working, you're staying with the trade. If it's not working, you're getting out of the trade quickly. And that's what I'm going to share with you today. Instead of a whole lot of stuff, I'm going to actually try to zero you in on kind of the best of the best type of swing trade approach here. Now, before I get into it, just a reminder that everything I'm sharing with you today is for your information and education only. Nothing that we talk about here should be considered a specific recommendation to buy or sell any particular security. And of course, you know that you are solely responsible for your own investment decisions. Big Trends and the staff are not responsible for any trades you choose to make. We seek to empower traders and investors and give you a lot of education along the way, but ultimately you got to decide what's the right amount of allocation and risk that you want to take on any trade, because all trades involve risk. We're going to talk about how we manage the risk today. Not all Big Trends products or services are going to be appropriate for all traders and investors, so always keep that risk level in mind. And we don't provide any personalized financial, tax, or legal advice. We send our research out via real-time email alert and now also to your smartphone real-time text alert, so then you can decide how you best want to use those new trade alert entry and exit signals. Do consult your tax advisor too before you make any investment that's going to impact your unique tax situation. Okay, so what we're going to talk about today are what are the FANG stocks, but in particular then how can we use weekly options to basically focus on a shorter term lease of that stock. Why buy the stock when we can lease it with weekly options? And in particular, why I really love the weeklies on these higher dollar stocks like the FANG names. As I said, I want to focus you on just one simple indicator to help you to define a trending stock. Now, you could use what I'm going to teach you here today on pretty much any stock. It just so happens that the FANG stocks we found are basically driving the market. The bull run that we've seen, the Nasdaq's up over 20%. The FANG stocks are up a lot more, as you'll see from the charts I'm going to show you here in 2017. Also, we get a lot of requests about, okay, how do you create a regular income stream? So I'm going to show you how you can actually create a consistent check in the majority of months to actually be pulling money out of your account and still allowing you to take advantage of the growth potential of these FANG options trades. Now, when we talk about FANG stocks, what are they? Jim Cramer, I would say, gets credit for kind of initiating this term, and each letter stands for a particular stock. F stands for Facebook, ticker symbol is FB. And what's interesting is that we've even added an A in here. You see A stands for Amazon traditionally, of course, dominating the retail space more and more. We actually also threw in another bonus A, which is Apple. Of course, Apple is not considered traditionally one of the big four FANG names, but our testing showed that it deserved to be included in with these other big four FANG names. N for Netflix, of course, disrupting the media business with the streaming binge-worthy content. And then G for Google. Of course, Google then since changed their parent company name to Alphabet. So, but we all still know it as you search for something via Google, you don't alphabet it, you Google it. So, so that's the big four FANG names plus the bonus stock of Apple. That means we only have to focus on 5 stocks. Now, there's multiple benefits to this. One, you don't have to jump around to literally dozens or hundreds of different names. You can focus on the top 5. But also, these big 5 key FANG names, mostly technology oriented here in some shape or fashion, even with Amazon and retail, Netflix and media, it's still technology oriented, why these stocks have disrupted industries. That they're very active in the options market as well as the stock market, so that when we go in and buy our options or get out of those options, we can actually know we're getting a fair price, and it's not us against the market maker, it's us against a lot of other traders. So with that in mind, you say, okay, so what do? We actually make options recommendations where we can have these type of results that we've been able to achieve. 102% gain we had in Apple in just a couple of trading sessions, 88% in Google in a couple days, Netflix 46% in a couple days, Facebook 74% in a couple days. These are just samples of the kind of gains we've had. And then 168% we had in Amazon in just 3 sessions. So, one of the benefits of this approach is that we're going to be getting consistent signals. We're going to average on this particular FANG options trader approach in the neighborhood of about 8 to 10 trades a month. So we're very confident that we can actually benefit from, really helping people to find reasonable activity, not excessive activity. We don't want to overtrade. We want to definitely focus on more of the, prime trading candidates here. And then from this, we're going to then say, okay, so what have our results been since we launched this back, looking back to July? Now we've got 10 months under the belt, and you can see that we've totaled $3,896 in gross profits. Like we said, in the course of 10 months, you got to factor in, if you've done, say, an average of 10 trades a month, that'd be about 100 trades over 10 months. So take your commissions out of that. We know everybody's commissions are different, but commissions have come down dramatically. If your commissions in option trades are not, frankly, if you're just doing a contract or two, if you're paying more than about $10 a side, you're paying too much, and you should hopefully be paying even less than that. So you can really get your commission costs down and have a lot of net profits left over. As we know, it's not just what you make, it's what you keep. So we want to make sure that your commissions are reasonable. If they're not, you can check with my lead consultant, Chris Sayre, who's helping to answer questions here over the course of our time on this investor inspiration event to give you the big trends approach to, okay, brokers that can help you in the option space. Very reasonable. We didn't even include the June profits thus far because June's not done yet. But as of today, right now, we're up $421 so far, and only about a week into the month of June. So, whether you're trading a $5,000 account, a $10,000 account, or whatever your number is, you can employ this because we're not going to carry more than 2 trades open at a time. Our model portfolio, we use a sample of $1,000 into each trade. So you could do that with $1,000. You could do it with less, but we would recommend typically that you could potentially get $1,000 into each trade, because sometimes we're going to have to buy an option on one of these higher dollar FANG names that could be as much as $10 an option contract, which means it costs you $1,000 to control 100 shares of stock. Now, what's interesting is we break out these results over the last 10 months on a month-by-month basis, using that same, like we said, $1,000 a trade, never carrying more than 2 on here. And we're going to get into the charts here, so I'm just kind of giving you an overview here first of the results that we've generated, then we'll get into the charts. Bottom line is that what we're looking at is that, okay, if you were just saying you'd like to turn this into an income strategy, even if you were trading, say a $10,000 account, basically you could be pulling out $265 would be like, taking out 2.6% that month out of your account as profits back to you. These are gross profits before commission, so factor your commissions accordingly. But you see $890 in September. That'd be an 8.9% return in a month on gross profits. October, 5.8%. Now, here's what you have to do when you have a losing month. If you're taking out all your profits as an income strategy each month, when you do have a losing month, which, let's face it, not every month is going to win. When you do have a losing month, you need to basically offset that and say, okay, I've got to now, I don't want to take anything out in November because I gave back $560. I wait until I make that back up. You can see in this case, December made it back up. So basically, you don't take anything out in December, but you've replenished your capital base back up right to just $6 under that starting 10K. So you think about it, if you're at plus 2.6 on the first month, you're at plus 8.9 on the second, et cetera, you're going to have 2 months where you're flat. Okay, so basically in this case, and again, past performance doesn't guarantee future results. You might have to wait while you come back out here. But if you think about it this way, even though you were down in November, essentially you took nothing out, and then you took nothing out in December, but you're still at least flat over those couple of months. Then you're back to plus 5.8 in January, and you can see how this would work. You take 5.8 out on this one, and then you see now you give back 148 in February. So again, you got to make that 148 back in March, and you see here that you do that and then some. You're still up over $1,100, or I'm sorry, over $1,000 in March. So you still be up in the neighborhood of about 10.4% at least for March net when you factor that February would net out at 0 that you could take out. Same thing with April, 0 you could take out. But you see, May, we made up for that just under $300, and you still had about over $500 left as a percentage, you can think of it. So you'd have, you can see some really nice gains you could take out most months, and then basically that's how you would replenish your capital base through that type of a strategy. When you're down, you don't send yourself a check that month. You just say, okay, I'll replenish that. When I have the excess funds, I'll take it out. So we're not trying to compound our results here when we show you this. We're saying, look, this is just a way you could use your existing capital and create an income stream off of it with this growth-oriented strategy. Now, I'm kind of curious what kind of crowd we have with us today. I'm curious, would you classify yourself as a day or quick trader, 1 or 2 sessions? Type in the number 1 in the chat box. If you're more of a swing trader, 3 to 5 days, type in the number 2 in the chat box. Just kind of curious, 1 to 4 weeks would be a position trader, or any other type. Just kind of, obviously longer term investors, active investor, passive investor, 4 and 5. Just always good to know kind of where people are at. And we do get a lot of people that these days are in the swing trading type of a horizon here. So the number 2 is tending to be the most popular one. Kevin mentions that. Bottom line is that this is going to be something that would be, I'd call it a 1.5 here. We're somewhere between the quick trade over 1 or 2 days to the swing trade over possibly 3 or maybe 4. So our average holding period is probably going to be in that couple of day range, okay, in this case. So if you're not used to taking profits that quickly, then basically I'd say get used to it, or consider trying it for a month. When I tell you how you can get started here very, very reasonably, and we take the attitude, hey, if we're not producing, we don't expect you to continue your subscription. So we constantly have that performance mentality here at Big Trends. Like I said, launched the company in '99 and still going strong because we really cater to people that want results. And the key is we're going to talk about today how you can manage your risk while also letting your winners run. It's a classic cut losers quickly, let profits run. Every trading textbook tells you that, but very few of them actually give you the specific mechanics on how to do that. Now, we use a lot of different platforms: TradeStation, Thinkorswim, Metastock. You don't have to have those platforms. You could use pretty much any platform as long as you've got the ability to plot some of the indicators I'm going to show you today, especially this one here, the average directional movement, ADX. This is going to be my main focus area here. When we really boil it all down, ADX, the average directional movement, is what we're really especially focused on. But we use some other filters. We do have a moving average filter, so we make sure that we're not fighting a bigger picture trend. And then we'll talk about the other components, the directional movement indicator, DMI lines, and the average true range, ATR, that go into that ADX calculations. We call this our trade funnel because, let's face it, when you have a lot of ideas here, you need to have something that's going to narrow it down and really get you down to the best of the best opportunities that can create the dollars for you. If you're doing too much up at the top of the funnel and you've got too many positions on, you're probably going to miss out on a stop or an opportunity that you should have taken. Okay, so let's focus on the indicator I want you to understand here along the way. Okay, now the building blocks, Wells Wilder developed this directional movement ADX, average true range concept. He's the same guy who invented the RSI, relative strength index indicator, along with a lot of other techniques. Very much of a trading pioneer. And my approach is, if it tests well, I don't have to have created it from scratch. If it tests well across whatever set of parameters that we go through and study literally decades of data to really make sure that we've got an edge over a long period of time, that's what we're after. I don't expect perfection. I look for consistency and kind of excellence in building equity, while also, and just as importantly, managing risk, so that we're not getting into a position where we're giving back our hard-earned profits too easily ever. We're always going to be very vigilant about protecting our run-ups, and even when we have some occasional stops, we want to keep them small enough that we can make them back, as you saw before, very, very quickly. Okay, so Wilder noted when we talked about the directional movement that the true range of a stock should include the amount of any gap. So true range is something that, when we talk about, what was Wilder really thinking about when he talked about that? Well, your typical bar chart might look something like this. You've got one day that, We start low, finish high. Let's say another day where you kind of gap up. Say you gap up in the middle of that range. You finish also about the middle of that range. Most people would call this second bar's high and low the traditional range. I'll just call it R. What Wilder was saying is you've got to actually draw a dotted line to the prior day's close and say, you know what, you actually have to factor in the prior day's close to the next day's open as the gap amount to get the true range. So of course, true range has got the potential on it because of a gap to be bigger than the traditional daily range. So Wilder was saying we've got to factor that in as well. So, you know, that makes intuitive sense. We would all assume these days that that would be almost a given, that you should factor in the gap. But back in the day, decades ago, a lot of people weren't doing that. So Wilder added that in and then started to measure an ATR, an average true range, to look at the total movement that you were getting. So what we're looking for with directional movement is how much net new movement you're getting in a trend. That is, are you getting higher highs in the case of an uptrend? Or are you getting lower lows in the case of a downtrend? Those are typically the drivers. Wilder would also look at how much the new lows are expanding or contracting. So in an uptrend, you want to see, of course, higher highs. You also want to see higher lows, right? That defines an overall period of rising prices. In a sideways move, of course, you know, we're getting no higher highs, we're getting no lower lows, we're getting just basically no net movement. So that would be a lack of directional movement. We would stay away from that kind of sideways period. We're looking for the trends, preferably the bigger trends, and staying away from the ranges with this approach. Now, with directional movement understood, what is ADX? This is basically taking an average of the possible various configurations of the positive DMI, that's the net new highs, and the negative DMI, the net new lows lines. When those two lines start to diverge, you're going to see that. I'm going to show you a chart next. You can start to visualize with a picture worth a lot more than my words what you can actually see on the chart, okay? And what Wilder says is take the directional movement that you're getting on net divided by the true range for that particular stock, and now you can get a percentage calculation that essentially we can compare apples to apples or Facebooks to Facebooks, so or Googles to Google. So let's look at Google here for starters here. And so we have, you know, our traditional view that we look at here for our FANG options traders is we look at half-hour charts, 30-minute charts. We find that with these FANG names that do move relatively quickly, half-hour charts are ideal because they give you good responsiveness, but they also minimize some of the noise. If you were looking at a 5 or 10-minute chart, I would say you'd be prone to too much noise, too much fake out, rather than the true breakout. So I just care about hopefully the better breakouts, and then staying away from as many fake outs as we can. Now you also notice the light blue line on this upper panel is a moving average. We're above this kind of broader moving average as we get our signal. That's why we would only get a bull signal on this and not a bear signal when we're above that moving average. Now ADX is shown here as the green line on the bottom panel, okay? And ADX, you can see here, is going nowhere there in the first half of the chart, right? The positive DMI in blue, let's call it DM plus, is the net new highs. And then, of course, DM minus is in red, the net new lows. So what you see happening is while Google was chopping around, yes, it was holding support, but it was basically going nowhere those first few sessions. Look at how our ADX line, this dot, is basically headed lower. Even when it tries to turn up, it's staying relatively low. And my definition of an ADX turn up that's actually good enough is that it has to get turned up through the declining directional movement. In this case, the negative directional movement is dropping as the positive directional movement is rising. As we get that lift off the moving average here, you can see that we're actually seeing the crossover point happen, in this case, right into the close on that particular bar. So we're getting our signal to buy into Google on the bull side. What's interesting is way back in the day, when we're talking, so ADX, Scott, is just the basically essentially tracking when the DM lines are starting to diverge. That is, a positive direction movement's rising. You're also not getting any new lows. Your negative direction movement's dropping. that means that that gap between the DM lines, directional movement lines, is actually widening, and that's what ADX is showing you, is that you're picking up a trending phase as ADX turns up the average of that gap between the directional movement lines. Now, from this perspective, you see it's got to widen enough that ADX comes off of a low level and turns up. That's got to be what's got to happen. I don't look at any old ADX upturn. You can see back here the day before or earlier that session, it tried to turn up, but it was not crossing above either of the directional movement lines yet. So we didn't have any real clarity on which direction ADX was telling us the market wanted to go. The complaint about ADX back when I got started trading 25 years ago was people weren't actually overlaying the directional movement lines on it. They were just looking at ADX as its own panel, and then they were saying, well, it's a trending market, but I can't tell which direction it's trending. That complaint has been erased because I overlay the directional movement lines, and whichever one is leading the train, in this case the positive directional movement in blue above the negative directional movement, that's actually a confirmed bullish trend. Okay, now where are we going to get out? We will get out on any 30-minute close where ADX has now turned down. Okay, so we're going to say, look, the first end of the 30-minute bar close where it turns down, we're out. Sometimes intraday it can look like it's intrabar it can look like it's turning, but then end up holding by the close of that 30 minutes. You got to wait for the 30-minute closes to make it official. But you can see here, it looks like it's flattening out, but there's a little downturn happening right there later the next afternoon, and we're hopping out into that. Doesn't matter if the stock rallied back up or if it came back down. What matters is that the directional trend is now the cleanest sweet spot of the directional trend is now ending. Now, we wouldn't bet the other direction because, of course, you see that the positive directional movement was still above the negative. You can go through just normal consolidations, then the stock can resume. And so the bottom line here is that we really want to focus on just kind of the cleanest phase. Now you say, what about this next day where you see ADX turn back up? I'll put a question mark on it. No, because we're still above the moving average. It would be a positive. You see that while ADX was moving up in the negative direction, movement was starting to pick up. See how we came right back into that support line. And if you were betting on the downside and hoping that was going to break, the next morning you get a rude awakening as the stock pops back up. So from the time you would have shorted to the next morning's close, you would have actually lost money there. So we stayed away from a potential problem area. And you see ADX actually wasn't even low enough to cross above the declining directional movement either. So this is, again, why we're really picky about these setups. I'm going to show you some more charts, but I want to also talk about why I absolutely love weekly options, especially on higher dollar stocks like the FANG stocks. All the FANG stocks are trading over $100 a share. And of course, Google and Amazon are now pushing $1,000 a share. Okay, so Amazon's over, Google's at $9.99 as I speak. Okay, so the bottom line is that, you know, the leverage potential on these higher dollar options is tremendous. You would think the options market should adjust for that and that it should all kind of balance out in the wash. But let me show you how that's not quite the case. If you're looking at a $20 stock versus a $200 stock, 10 times as expensive, and you say both of these stocks are going to rise 5% in 5 trading days, you would think that you should make about the same money on similar type options. So what I'm going to do is I'm going to buy slightly in the money in both cases. I'm going to go 2.5% in the money. So a $200 stock, I'm going to buy a 195 call. We're assuming we're about a week out to the expiration in this prior example here, and then 2.5% in the money on the $20 stock, so 19.5. You know, again, it makes sense, right? A factor of 10 difference, 19.5, 195. But what's interesting is that when you look at how much those options are going to cost, going about a week out, the $20 stock, we put it in an options pricing model, came out with similar volatilities for a $1 entry price. For the 195 call, it came out with a $5.50 entry price. Now, what's interesting is you say, okay, well, yes, those options are more expensive on the $200 stocks call options. You would expect that, but what's interesting is that you've got some different characteristics of the option. The high dollar stock in the money option actually has a pretty high delta, 90% delta. That means that if the stock moves up a point from 200 to 201, that option should move up 90 cents, 9% of that. So 1 point move on, I should go from 550 to 640 for the stock, basically going up 0.5%. You can see the delta on the more cheap stock is only 65%. And thus our time value, which is called extrinsic value in this chart, is 50 cents in both cases, but 50 cents out of a buck is 50% on the left on the cheaper stock. That's half of your options exposed to time risk. On the right, only about just under 10% of the option, 5 out of the 5.5, 50 cents out of the 5.5 is exposed to time risk if nothing happens. So let's just assume we're going to buy in the same number of dollar contracts. So in this case, on the right, we could buy 2 contracts for 1,100 bucks. So we match that up with on the left, 1,100 bucks will get you 11 contracts at a buck a piece on the $20 stock. If you get the 5% move from 20, you know that you're going to 21. So that means, of course, at the expiration, that's how we calculate these results. That a 19.5 call at 21 is worth $1.50. You paid $1 for it, you made 50%, $550 in gross profits. Okay, that's nice, right? There's nothing wrong with that for a week's work, but it's all relative to what we could have done if we had just 2 contracts, and the $200 stock now goes to what? It's going to go to 210 versus the $20 stock going to 21, right? So basically, we're just comparing the same 10 times move here. 200 goes to 210. What does a 195 call have to be worth at 210? It has to be worth 15. So 15, that's $1,500 a contract. We have 2 of those. That means that we're worth 3,000 bucks. We paid 1,100. We're up 1,900 bucks, 173%, more than 3 times bang for your buck buying for that same dollars, that higher dollar options versus the lower dollar options. And this was just based on not just having the same time or extrinsic value there, Jay, but it's actually based on just saying, look, if we bought 2.5% of the money in both cases, what did the options pricing model tell us for similar volatilities that we were going to have to pay for the options? So the point is that it's a lot easier to get a 1-point move on a $200 stock than a 1-point move in a $20 stock. And so you would think that the percentages would balance out, but actually it works in our favor to buy higher dollar options as long as we're only in for short windows of time here, you know. So we don't want to just, and the key is that we want to buy in the money wherever we can. That in the money example is where we're getting more of the intrinsic value stock substitute and less of the time risk. Okay, now look at Facebook back here. When Facebook started to go on the second half-hour bar in, you can see it first surged up, but we didn't quite get the turn up there above the declining directional movement. It happened on the second bar in. For Facebook, that was like 128, just under 128, called 127.5. Now, if we're at 127.5 and we buy a 124 call, you know that means that if you're new to options, a 124 call is a right to buy the Facebook stock at 124. It's already at 127.5. That's worth $3.50 intrinsically. When we pay $3.90 for it, that means we're only paying an extra 40 cents or just over 10% of our option premium as time risk, or what's called extrinsic value. The time risk is what we're trying to manage. It's kind of that principle. Why would you pay 127.5? That would cost you basically $12,750 to buy 100 shares when we can control those same 100 shares for just $390. That's where your leverage kicks in with options buying compared to buying the stock. You can see in this case the stock surges, and then what I love about ADX too is you'll see times where you go through a flat period. After the first surge that we caught, it flattened out later that session into the close. And you see the DMI lines, the light blue lines, starting to edge down. Even the negative DMI line's not going down anymore, it's starting to maybe edge up. You'd think that would pull the ADX down, but look what ADX is doing. ADX keeps on going up. That's what we love about ADX. It's very, very steady, that it doesn't whipsaw you based on the kind of thing that a lot of people would get whipsawed. If you're using the first close below the prior bar's low or something like that, you're going to get whipped on a lot of these situations. We're trying to stay with the trend. You see it surges the next morning, and then it does start coming back down, and it's still better to the good when we get the exit signal than if we'd sold at the end of the prior day. So the key is you give yourself a chance to let it keep running, but if it doesn't, you see where the ADX starts to roll over here, then we're out and it's anybody's guess. Same thing as Facebook turns back down later on this chart, you can see it was not coming from where it needed to below that lower of the 2 DMI lines. It was also still positive on the moving average here, so there's no way that we would take that. Even though you say, gee, that could have been a profitable trade, the risk when it catches that moving average and bounces back up is too high for us to want to take that trade. So we're going to make sure we keep you with what we consider to be the most positive configuration with this. And one of the, if there's a concern that people have, if you're working a day job, if you're afraid of missing a trade alert or something, even though we can send it to your smartphone as well as your email, some people have a concern, oh, I might miss out on this trade and thus miss out on the benefit of your research, a big trends price. Well, we do have brokers who can automatically get you in and out, and it costs you no more than what you would pay if you did it yourself on their platform. So check with Chris there. My lead consultant who's answering questions here, he can get you more details on how that auto trading can help you to not have to lift a finger, and you just tell them how much you want to risk a trade. And then when we send a new alert, they get you in. When we say to get in, when we say to get out, they get you out too. Okay, so we never leave you hanging. So that's something else you can look into. Now, a lot of people, when you read the options textbooks, they say you want to focus on volatility because volatility is theoretically the only thing that the options pricing model doesn't actually know. So therefore, that's what everybody focuses on. But guess what? When the guys who created the options pricing model back in the 70s, you've heard of the Black-Scholes model probably if you've traded options for any length of time. Those guys, after they won the Nobel Prize in the 90s for the options pricing model, where did they go? They went to a hedge fund called long-term, two of them went to a hedge fund called long-term capital management. If you don't know about LTCM, long-term capital, about bankrupted the financial system because they were using so much leverage, and they were wrong in 98 in a big way, and basically had to get a huge bailout from all the other banks and brokers along with the Fed. And long-term capital went away. So the assumption that trends don't exist ended up costing long-term capital billions and their investors billions of dollars, and where it's a badly wrong assumption. So my belief is that when you can find strong trends, you've got a huge edge here. Now, we want to focus on not at the money options and not out of the money options here as much as we can. Obviously, Amazon and Google, we've now had to go a little closer to the money because they're $1,000 stocks. And so, we're keeping our premium at $10 or less. That means we're going to have to buy on those two a little closer to the money. But where we can, we want to buy in the money, because in the money actually allows you to basically create a stock substitute approach and reduce the impact of time loss, the impact of volatility changes on your option, and focus on really the pure trend. Now, here's an example with Amazon. You can see Amazon back in late March. This was the one that gained 168% for our FANG option traders, 168.97 to be exact, in just a total of 3 sessions. So we're in there on the 28th of March. You can see ADX is starting to turn up here, but we're waiting until it does what? Until it crosses that declining directional movement. Put a box on that. At that bar's close, we're getting the new signal. That was around 8.55. We were buying as in the money as we could in 8.52.5. We paid 8.70 for it. So if you're committing $1,000 a trade, that means you get one contract at $870 plus your commission. So from this perspective, you say, okay, I get one contract. That doesn't sound very sexy, right? To get one contract, but when an $8.70 option turns into over $20, basically, you're saying, okay, look, I'm getting the leverage that I want. I don't need a lot of contracts. I just want to make sure I'm taking advantage of these signals when they happen. Again, look at that little dip in Amazon late in the first afternoon that we got into the trade. You see, ADX looks like it's starting to nearly flatten out, but it never turned down. That's the key. And then the next day when it gaps up, you see ADX just keeps on chugging up. We stay with it into the second day's close, into the next open. You see, that next day, we start to kind of spin around a little bit, and we're getting out once ADX is rolling over slightly. Now, this is a case where you think, okay, the other examples I showed you, the stock came back down. This is a case where Amazon kept eventually racing up. So we got the first leg of that move, and Amazon went over 900 on that particular move. So it's one of those that you just want to be, actually, it went, where did it go to? Yeah, it went up over to like 920. But basically, you say, look, this is one of those you want to make sure that you just follow the indicators, follow the system. Only get in and out when you've got an edge. If you don't have an edge, don't trade. Okay, that's what we've always preached, and all of our testing is based on making sure we've got a meaningful edge here. So from this perspective, now when we're focused on, okay, how how we can go. And I need to I know we started late, so I assume they're giving me a similar amount of time. But basically, I want to just focus on a few more key concepts for you real quick. Why would we pay now? Google at the time when I did this slide was about 860. Now it's basically $1,000. Why would we pay basically 100 grand to buy 100 shares of Google when we can trade one Google call up to pay no more than $1,000? Obviously, if you pay $1,000 for a Google call and the stock's at 100 grand, your leverage potential is going up close to 100 to 1. In this example, is more than 80 to 1. And the key is then let's make sure we just get the leverage when we're in the sweet spot of that trend phase. If you know you've got an edge, then you want to be consistently taking it on every trade. And then when that edge goes, when you no longer have that ADX turning up, we say get the heck out and ask questions later. So we will manage risk first and foremost to make sure that we can stay in the game and keep subscribers in the game for the long haul. So that's where I think Big Trends is a lot different. A lot of other services I see put out trades and then you never hear where they got out, or they'll only tell you about the good ones. We focus on every single trade and we make sure that you can manage accordingly. What about a downside example? Here's one where Google was actually breaking our moving average right as it gave the signal. You can see that now the negative directional movement in red, the DM minus, remember, is actually above the DM plus. So now as the ADX turns up, it's actually a negative trend. And you can see this one steadily went down, it reversed back up. And of course, this is one where by the time the reverse back up, we hadn't made that much. So we only made 18.9% the next day. So the point is that yes, if it doesn't move that quickly, then yes, you're going to see that some of that time erosion is going to make it a little less leveraged if you have to hold it for a long time and don't get a lot out of it. We were out, in just over 24 hours, two trading sessions though, and we very much manage to make sure that we don't do a lot of day trades. Now, quickly with weekly options, what we're talking about here is that weekly options now on all these FANG names exist out. Every single Friday has an expiration. Our focus is the next Friday's expiration usually. So right now we'd be looking out into next Friday's, in this case it would be the June 16th expiration. Those happen to be monthly options that now will trade like weeklies in the last week and a half of their life, okay? So that means you're getting a lot of the time out and you're basically just why buy the stock when you can lease it with an in-the-money option where appropriate. We will try to take advantage of events, but really trade after the breakout, after the follow-through, after the catalyst kicks in. So the keys for FANG option traders are we've got to see that momentum breakout catalyst to the upside or the downside. And that's where the ADX shows us now we're going into trend phase. Now, sometimes you get into trend phase and then it flips on you and you got to hop out quickly. But like I said, we're not going to have too many of those kind of day trades. If we got to hop out real quickly, we'll be very sensitive to that. And like that's why we will never hold more than 2 trades open at a time among the big 5 FANG names. So if we get all 5 FANG signaling throughout a day, we'll take the first 2 that signal and then follow those through and pass on the rest. So you'll never have too much exposure at any one time. This higher delta approach gives you more of a stock substitute play. That allows you to really take advantage of this this approach. And then the exits are dynamic based on the ADX. We don't set any arbitrary stops. No set targets either. So that's why we can get gains over 100% like Amazon, 168%. And then we give you weekly training videos where I show you, okay, what we've done on whether it worked or didn't. I'll recap every single trade. A trade we did here this past week made us a little over 20%, was on buying the Amazon June week 2, 1,005 straight calls. This is not a fresh recommendation. We're out of this. Don't buy this one. But basically, we said buy to open that option at a price of 9 or better. Our auto brokers got in at an average price of 870. We were then able to get out, there just the start of the week for a nice plus 20% gainer on that one. Like I said, if you came in late, over the 10 months, the gross profits we've added up to over $3,800, $3,896 in total gross profits. Take your commissions out. Like I said, we're going to do 8 to 10 trades a month. You can see the kind of gain potential that we have here on a month-to-month basis, knowing that not every month is going to be positive. Okay, no system works 100% of the time. Anybody who says that theirs does, you probably just haven't seen the drawdown phase yet. So I always say plan for the worst, hope for the best, but always plan for the worst. we expect this to make money the majority of the time, but when it doesn't make money, you just don't take money out of your account that month. But most months you could be pulling money out of your account, and then if it has a little off month, then you just make that up in the following month or two if needed, whatever it takes, and just be consistent about continuing to stick with it. That's what I see. Most people get too high or too low. They want to plow too much money in or too little money in. I'd rather see you plow just a nice, small, steady amount in on each trade and stick with the system over time. Now, before we wrap it up, I did want to share with you how you can take advantage of this. You see the link there at the bottom of the page that we've set up for you here is bigtrends.com/FANG options trader. And I know Chris Sarah's posting it for you right now. I'm going to actually pop this page up real quick to show you what it looks like. Usually people pay a lot more than this for a year-over-year basis, but as a thank you to Investor Inspiration, which does a great job helping get a lot of great educators out there, I wanted to give you an opportunity to take advantage of this for our lowest possible pricing that we usually just give to our most loyal subscribers, which is, we usually be 99 bucks a month. I can take it down to 69 bucks a month, and this becomes every month, every 30 days auto renew unless you tell us not to. I'll show you how if you need to cancel that, how you can cancel it. But what you do once you go that page at bigtrends.com/FANG options trader, that's the name of our service, is you add this to your cart. Now down below, by the way, you'll see lists of all kinds of trades that we've had success with recently, and basically the other goodies that you get as part of the service, focusing on these big 5 FANG names. When you click that button, you'll just see the green checkout. We've already applied the best savings on this. 69 is as low as I can take it. And then you just hit the green checkout button and it'll pop up into a secure HTTPS page. The key fields you need to fill out here in bold. So you can see a lot of our services run like, we've got toolkits if you want to be able to try to do this yourself. You can pay 500 bucks for that. You can pay 1,000 bucks for my Winner Circle weekly training sessions. But here you're getting this for just 69 bucks for the next 30 days to try it out. If it does what we've been doing, I think you're going to want to stick with it for a long time. And the bottom line is that, okay, you say, okay, it's got all that. You get all the major credit cards that you can get squared away, and then you can just click my name, or Chris has helped answer some questions for you, or you clicked on a webinar, whatever it is, click on that. Now if you want to get the text alerts in the customer note field, you can actually just type in here, text me the alerts to whatever your number is. So type your number in there, and then also mention if you use AT&T or if you use Verizon or whatever you use, Sprint, you name it, put that in there, because we put each of our text providers on separate batch lists to make sure nothing gets hung up. Once you've got all your information in there, you just review the terms and conditions, which are spelled out on this link, the first green line there, bigtrends.com terms and conditions, and then review that. Once you've reviewed it, click on that box that you agreed to it, hit the submit order button. And like I said, if it's not for you, after you try it for the month, anytime in that first month, this is an auto renewal program, so review that, because if you need to cancel, you can just drop us an email, something in writing is what we need to tell us, okay, you don't want to continue to do it anymore. I think you're going to see with the kind of results that I showed you before, just how well you can start taking advantage of these names that are really driving the indexes. The Financial Times had a report recently that showed that 10% of the S&P 500 names were driving over 80% of the market's profits year to date. These big 5 FANG stocks are definitely in that top group where they've really been driving the market to the upside. When the market rolls over, they'll drive it to the downside as well. We'll profit from both trends on the way up and the way down via the FANG options trader service. In the interest of keeping all the good folks at Investor Inspiration on time and not taking any more time than I was allotted, I'm going to go ahead and say, let me hand it back over so I can get you ready for the next speaker. But make sure you go to that page, bigtrends.com/FANG options trader. That'll get you to the best pricing we've ever had and you'll take advantage of this and see it for the next 30 days. Check with Chris here too if you have any questions on our toll-free number on the top right. It's 800-BIG-TRENDS. If you can't remember, just call us toll-free at 800-BIG-TRENDS. Chris can get you more details about how auto trading works if you need to get set up with a good options trading broker and want to take advantage of those signals automatically without you lifting a finger. But you'll have to get signed up here first through the $69 special, so check it out. I think you'll love it. Call us if you have any questions.